At the end of 2023, investors had few complaints after major rebounds in stock and bond markets. But if the rally had a drawback, an anti-silver lining, it was the lack of breadth in the market's revival. Mega-cap growth stocks blew away small caps, value stocks, and sturdy dividend companies, star players that covered up their teammates' middling performance. The good fortune has widened out a bit in 2024, but many of last year's trends have spilled into this one. That has sparked lackluster returns for good ETFs covering bad sections of the market. Today we'll hit on 3 of them, all of which should fare well if their areas of focus can return to form. Let's start with T. Rowe Price Dividend Growth ETF, an actively managed fund that trades under the ticker TDVG. This strategy earns a Morningstar Medalist rating of gold, but finds itself in a slump. It trailed the Russell 1000 index by 13 percentage points in 2023, and it ranked in the large blend peer group's bottom quintile for this year to date through April 12th. The fund's recent woes aren't a total surprise. It focuses on financially healthy companies poised to grow their dividends over time. These firms, like United Health Group for example, normally weather market downturns well but fall behind in rallies. The holdings that constitute TDVG have certainly lived up to that billing. But there is reason for optimism. Manager Tom Huber boasts over 3 decades of investment experience and has artfully led this strategy since March 2000. From that point through March 2024, the mutual fund version's risk-adjusted returns ranked in the best 10% of the large blend category. It captured nearly 90% of the broad market's upside over that span, making it more than just a bear market ballast. So far in 2024, it's been double trouble for silver-rated iShares Core S&P Small Cap ETF, ticker IJR. Small caps as a whole have languished, and this fund has fared worse than most. The fund shed 3.2% for the year through April 12th, ranking in the bottom 15% of the U.S. small blend category. After years of trailing large cap companies, small caps sport fairly attractive valuations. According to the Morningstar price to fair value ratio, they traded 18% below their fair value entering April 2024. Mid caps came in at just a 3% discount, and large caps at a 5% premium. IJR is a great choice for small cap believers. It tracks the S&P Small Cap 600 Index, whose liquidity and profitability screens filter out a lot of the junk that plagues more lenient small cap products. The benchmark is also market cap weighted. That approach isn't quite as compelling as in the large cap arena, but its cost efficiency allows the fund to charge just a 0.06% fee, far cheaper than its active rivals. Rounding out today's list is Vanguard Long-Term Bond ETF. It trades under the ticker BLV and earns a Morningstar Medalist rating of gold. Though you wouldn't know it by the fund's recent performance. It ranked in the long-term bond category's bottom quartile in each of the past 3 calendar years, then ranked in the bottom 2% of the peer group to start this one. Interest rate risk has been this fund's Achilles heel. Its average effective duration is one of the longest in the category, making it more sensitive to changes in interest rates than its competitors. As sticky inflation sparked interest rate hikes and delayed subsequent cuts, that posture has battered this fund for quite some time. But there's plenty of hope for it. It weights bonds by their market value, translating the market's read on each security into a portfolio weight. The US bond market attracts wide attention, making it hard to outsmart the market, and as a result, this portfolio. Plus, the fund charges a razor-thin 0.04% fee. That lowers the hurdle the fund needs to clear in order to beat out its long-term bond peers.